4 consecutive days of lower highs and lower lows. Is this the beginnings of the intermediate pullback? I'm going to break that down today and see how bearish this 4-day losing streak has been and whether or not we should anticipate more selling into the end of the week, or are we going to bounce? What are the technicals showing us, not only in the market forecast but on other charts, and what's really causing the sell-off today, and how can we take advantage? Let's go ahead and get started. Today is Wednesday, September the 5th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight, especially those that are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Mouse over the the Market Scholars logo here in the bottom right corner of your video. Click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That lets me know two things. You like the video tonight and you want us to do it again tomorrow. That simple, easy way to give us feedback. You can do that right now while you're watching. Comment on anything that stands out to you from tonight's video. Is there something that stood out that you learned that you didn't know about before, or any questions you have? Just scroll to the bottom of the page further and you can comment down there. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click on that link to subscribe. Follow me on Twitter for more content like this throughout the day. Also join our Market Outlook community on Facebook. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. And you see we've had our third down day in the past 4 trading sessions. You can also see too that every high was lower and every low was lower. So we've had 4 consecutive days of lower highs and lower lows. You also notice I got some Fibonacci lines drawn here. Again, this is the Fibonacci retracement lines of this current intermediate run that we had off of this low point to what is currently the intermediate high point during the run. You can see the 23% Fibonacci retracement, which we're still easily up above, closing up at 28.88. That line about 28.67, 65 looks like, which also happens to coincide with this old January high point that we hit. So we're still in a near-term pullback. This is still just a near-term pullback. The near-term line is below 50, and there's no reason yet to think of anything different. We're not breaking through support. We're not even breaking down below the prior near-term low point. There's the prior near-term low point right here, which wasn't that many days away, but it was a 2-day pullback that produced a higher low that we're still easily up above. So we're not breaking. We haven't even broken. So here's the near-term high that we're falling from. There's the near-term high before that, which again lines up with this 23% Fibonacci retracement. We haven't even broken the old near-term high, much less that near-term low that followed. So again, still a near-term pullback. It is 4 days. It is, the only sign of weakness you could say is that we are now 3 days into this near-term line below 50. And the typical range is 1 to 3 days. So it happens to be in the longer end of that range. So it's not like noteworthy in terms of red flags, but it is, relatively weak. And that's what we're getting is a near-term, is a more of a near-term pullback than we got the last time, but not enough of one to say this is the intermediate pullback. This is the drop that will produce a dark pink shading, which causes the intermediate line to fall below 50. So still not there yet. Remember, we've had a few times during this current run right here and right here where the intermediate line fell. In fact, even dropped below 80 briefly before bouncing back up. So, again, we would expect the same. We're now a little bit more than 2 months into this intermediate run. The typical time frame is 1 to 3 months. We were looking for 2 to 3 months back here when we got that overbought cluster, that kind of stamp of approval that we're really bullish here, bullish enough to have a good extended run, which we've had. So, definitely want to keep our eyes on how we trade relative to this old near-term high and low point. If we break down below that old January high point, and even then we'll have this Fibonacci support area here during a more intermediate pullback that can hold us up and provide some support down here around 2800 into this. There's your 50% Fibonacci retracement, which is a little bit above 2800, which you can see lines up with this area here as well as that intraday low point. So, so if you're looking at this to kind of say man, we are we are definitely bearish. The tide has turned. The tide hasn't turned yet. The waves have gone out a little bit, but the tide hasn't turned to where the tide's going out. So that's kind of where we're at, and we'll see, where the next wave comes in and how far it comes in, and whether or not it's still reflective of a tide that's coming in with the intermediate line posture, making a run potentially for that 3-month mark that we typically look for. The Dow Jones Industrial Average did not have, in fact, the Dow Jones actually gained today, less of exposure to those large cap tech names that were sold off today. Small range. You can see the near-term line and momentum line actually bounced up from this near-term low point. So they're back in the upper half of the chart. So a good sign, bouncing off this higher low. We didn't close above yesterday's high point. So not as bullish as we can be. Kind of hard to be without the S&P participating. Of course, the NASDAQ was the biggest loser. But also keep in mind that, see, the NASDAQ didn't have that pullback here that the S&P did. It kept going up. And it's been really outperforming. In fact, if you look at the near-term line, above it turned above 50 right here, and you've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Let's see. Count that again. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So we've had 12 days of the near-term line above 50, which is towards the long end of a range. And we're just now pulling down, closing below these lows, but we're just now pulling down below 50, and with the momentum line falling below 20 for the first time this whole time. This is a bullish intermediate confirmation signal. This is a buy signal. We would expect that the NASDAQ would bounce next week. Excuse me, I had to sneeze there. Not necessarily next week, tomorrow. We'd expect it to bounce as soon as tomorrow. It might not. It might still trade kind of in the lower half of this range, but that's a bullish signal that we can expect it to bounce off of here with this pullback. You can see again, easily would be a higher near-term low point compared to the last one that we had here. And then the Russell 2000, which for 2 days now, we've had this kind of bearish divergence here with these lower highs. Also, we are, 13. Today still is above 50 on the near-term line, so it's got 13 days up above 50. Quite the run. And these last 2 days have been so bearish, we came off the lows quite a bit, and that's kept the near-term line up here. So, that's as much of a short-term sentiment pullback we've got. Again, the last near-term low point's over here. So, nothing suggests yet that this weakness in the last few days is anything more than just near-term weakness that hadn't yet started on the NASDAQ and the Russell until yesterday for the Russell and then today for the NASDAQ. And across the board, we're not seeing strong sell-offs. We're just seeing pullbacks after extended near-term rallies that we can, and even getting short-term buy signals to bounce off of these near-term pullbacks, as soon as tomorrow, if not by the end of the week, by Friday. All right, quick reminder that you can always watch our Market Outlook video on our blog at marketscholars.com. Just click on blog at the top. So again, marketscholars.com, and then click on blog. You'll find our posts usually towards the top of the blog. Scroll down, there's the video. There's the link to participate in the forum. So as you have questions or comments, or you want to interact with the community, our Market Scholars community, you can do so with tonight's Market Outlook video there, specific posts in the forums there. You have to subscribe to participate in the forums. You can click on this little image over here on the right, and that will take you to where you can subscribe. Very easy to do. There's our calendar that we have coming up, our class schedule. Remember, we ask that if you want us to do these videos, we ask as you're watching them that we get 3 clicks from you. Number 1 is to click this heart right here on tonight's Market Outlook tweet, and then click on that like button. 2 is to click this image, this Facebook image. It takes you to your Facebook page, brings up tonight's post, a Market Outlook post. We ask that you click on this like button right there, and then finally the third one is to click on that like button. The reason why we ask you to do that over and over again is because it tells Twitter that you want and Facebook that you want them to show you our content, whether it's from me, whether it's from Brandon, whether it's from our Market Scholars account. The more you interact with us by simple as liking these, the more they'll push you. And as you saw with today's testimony, They're very on guard in terms of what they push out to people, and they want to make sure that they push to you what you want to see. And the way you tell them, I want to see David and Brandon's Market Outlook videos, is by clicking those simple clicks that you can do right now while you're watching. All right, back to the charts. You can see what this pullback looks like here. Yeah, it's a down week. We had a down week a few weeks ago. We're still above a rising 50-day moving average. The 50-day moving average is still rising away, pulling away from the 200-day moving average, which is bullish. You can see that measured by this MACD. So again, continuing to maintain a positive trend. Hard to maintain, week after week of bullish moves without, this far away from the 50-day moving average, and for that matter, this far away from the 200-day moving average. So not surprising that we'll pull back. As long as the pullback is nice and steady, and we see that in the Heikin-Ashi, it is a smaller candle, but still not forming that lower shadow yet, which is kind of that second piece of weakness to look for a reversal pattern. Remember, we still got 2 more days left to push the close up higher and see if the close ends up getting above last week's Heikin-Ashi close. Let's take a look at the 3 green arrow charts here. You can see we have 1 red arrow, so we have some negative momentum now. Not necessarily strong, but negative momentum. The buyers are still in control according to the stochastics indicator. We're still trading in the upper 20% of the 4-week range, even when you average the last 5 days on average are still in the upper 20%. That's what the stochastics is telling us. In other words, the buyers are still in control, and we're still above a rising moving average. When you look at the 3 green lines, you can see the MACD and stochastics are falling, so that %K there is pulling back, still above 80, but pulling back below its moving average, and the MACD is also dropping slightly. That's where you got the red arrow on the MACD. But you notice, while we are flirting with the 8-day moving average here with a little bit below it, we're still holding the 17-day moving average, and we'll see if we get a bounce off of it like we did here after dropping and testing the 17-day and bouncing up to a new near-term high there. Again, that's what we would expect to see. Not that I think necessarily that September is going to be this barn burner month, but I do think that we'll at least bounce off of this and get up to at least a slightly higher near-term high point before we get more intermediate weakness. Of course, you break that 17-day and you break, there's the, like I said, the Heikin-Ashi low point, and we start testing the 30-day. Now we're looking at a different story, and potentially that intermediate pullback that we just haven't got yet. At some point in time we will get dark pink shading again on the chart. We expect it, we need it, so that we can get another good intermediate rally heading into the end of the year during the seasonal bullish time of year. So we can't have a 7-month rally. It doesn't work, and if it does, this is what happens after a 5-month rally. We don't want one of these again. We want it to be nice and orderly, and we want that intermediate pullback to come into this area here where we'll have good buying opportunity, new trend trades, new swing trades to the up. All sorts of things would be better if we got dark pink shading at some point in time. Will that happen on this current drop? I don't know. I don't think so. I think we'll get a new higher high. But at some point in time, potentially in this month of September, which is traditionally weak, we'll get that dark pink shading again. Whether it's to the 23% Fibonacci line only, whether it eventually gets to the 38, either way, as long as it's dark pink and it's a higher low and we bounce off of that, that's kind of what we need to be nice and orderly. As you look at the intraday chart, you can see, another day of lower highs and lower lows, but also another day of closing back up above yesterday's low point. So while we did trade below, just like yesterday, we traded below the previous day's low early before closing up above yesterday's low. Same thing. Traded below the previous day's low early before coming back up above yesterday's low point. So again, that's not that bearish when you get those kind of moves. That's why I don't think this is the intermediate pullback right now. There's the Heikin-Ashi low point. We need to trade up above and stay up above to avoid the lower shadow. We did drop below last week's low point today, so a little bit of a red flag there, but again, got back up above last week's low point by the end of the day, and we'll see if we end up holding that as we start into tomorrow. Lower high, lower low. You can see still trading not only just above this week's open on the Heikin-Ashi candle, but also still easily trading in the upper half of the chart. That's not going to change anytime soon, right? For this upper half of the chart to move up, Either the high point's got to move up, which means we're pushing up here, or the low point's got to move up, which it won't do for another week, because there's the low point there. So we're still got some really positive sentiment from a short-term standpoint. Remember, on a daily basis, if you look at the daily chart here, here we go, a little bit above average volume, higher volume that we've had for a while, about 72 million, with a lot of those large cap tech stocks trading. You can also see today's range, 1.75 points over here next to the R. So 1.75 points. Let's look at those numbers in context. 72 million, still very low volume, relatively speaking. 100 to 125 is the worrisome volume. Anything extreme, we bounce right off of almost immediately. 100 to 125 will start to bring the average up, which would be concerning. It already is turning up a little bit, but the average range, 1.75 points below the average, and still room for that to fall, still towards the lower end of the range too. Again, 3 to 4 points days, that's when you start to worry, and that would bring that up, and that would start getting us above the 1% mark on the relative ATR, since we're at 2.9. 1% would be what, 2.89. So that's when you start to worry. We're not getting those days even on these pullbacks. So that's why I don't think this is anything right now, at least, more than just a near-term pullback. Finally, looking at the volatility, you can see we're not getting a big jump up in volatility here. It's been mostly a grind. It's been more volatile than what we had previously, but it's still only about 14. You look at that in context, still very low, still below 15. There's a little bit of a resistance there at 15 that we've seen before. And you look at volatility on a relative basis, still right at the sweet spot. We've been trading a little bit above it lately, these last few days, but with this pullback today, we're trading right at the sweet spot at that 85% mark. This is the bullish zone for volatility to trade in, and we're trading right in the middle of it. So to summarize, the markets are still on strong bullish trends, intermediate and long-term trends. And we had some weakness here, but the weakness has been relatively muted and has just barely started, like in the NASDAQ and the Russell, which is probably why it's been a while for the S&P. It hasn't been able to bounce yet because we haven't had the pullback yet in the NASDAQ and the Russell that we finally got for the Russell starting yesterday, and then for the NASDAQ finally today. So now that everything has given us that short-term pullback, there's opportunity now for us to bounce, especially with the NASDAQ giving us that bullish intermediate confirmation signal, and all of the indexes setting up for bullish near-term low points. So whether or not we'll get strong new near-term highs, I don't necessarily think that's the case. I think we're really going to slow down now this far up above the 50 and 200-day moving averages until we get to the point where we get sometime here soon, and not necessarily next week or the next few days, but within the next few weeks, we'll probably end up getting that dark pink shading, that bullish, that bearish posture on the intermediate line that will set us up for a new bounce heading into the end of the year, into October, November, and December, where seasonally we typically get good trading, good time of year. So what do you think about that? Do you agree with that? Do you disagree with that? Let me know with the poll that's popping out there in the top right corner of your screen. Click on either agree or disagree. If you disagree, scroll down to the bottom and let me know what you're seeing that would suggest that maybe this is more bearish than the picture I've painted. And let me know what you're seeing that would suggest that's the case. All right, now let's take a look at what's driving the price action for today. And we take a look at the calendar, and you can see today was yesterday was the ISM number. And keep in mind that the ISM hit a new high point for this period since that March 2009 low that we've had. And so we're above 60 easily again, 61.3. Again, a new high for ISM. And I wanted to point out this tweet here with data back the last time, whenever we get a peak, if that was the peak in the ISM, if we don't get another peak from there, you can see the average length of time before the recession starts. See, we peaked in the ISM in 2004. Remember, the stock market peaked in October 2007, and then of course the recession started January of 2008. That was almost 4 years from the time that the ISM peaked to the time that we started a recession. And you know, we've had 9 months and we had 18 months and we've had 80 and 77 before that. So, you know, there's been periods of time where, you know, on average, we are about 4 years away with another 50% move on the stock and the S&P 500 from the peak going forward over that 4 year period. You can see last time again, just about an average amount of time with a 23% move higher over that 4 year cumulative period from '04 to, you remember the stock market peaked in '07, bringing some of those gains down. So we're not necessarily barking for a recession to start anytime soon when you see economic indicators pushing up here. And you can even see too the economic surprise index bouncing back up, and with the G10 economic surprise index getting up above zeros, which hasn't been the case for most of this year, finally getting up there. You can see the GDP estimates pulling back down a little bit today to 4.4%, still relatively high GDP numbers for Q3. You can also see too the odds of a rate hike aren't necessarily rising. So that yield curve, you can see it's kind of still the same for, this would be for March. So that next rate hike, which would be this 250, see the 200, that right now we're at 175. So September would get us to there. December would get us to this point, the expected December rate hike, which is about 70% odds. And now this would be for the next year, the first one for next year. And by March, we're still looking at below 40% odds of getting another rate hike in March. So still relatively low odds. And you look at the yield curve, when you look at the yield curve chart that we show you, and you can see here that the yield curve actually went sideways today. It's been dropping with the low end of the yields rising and the high end kind of maintaining a relatively flat line there. If you take a look at the week, yields on the long end are bouncing higher, and you can see it's reflecting here in a delayed drop in the yield curve. And again, just to show you kind of the last times that we've had these inverted yield curves, was multiple years before the market peaked here, but 10 months at least in this time frame versus a couple of years over here by the time we got this inverted yield curve. So again, we're not knocking on a recession's door anytime soon, and there's still potential for markets to trend in the direction that they are actually currently trending. It was interesting to see how they talked about emerging markets were struggling with currency issues in Turkey and Argentina. Turkey and Argentina were the two best performers today with Brazil. So the weakness was actually Indonesia. That was their biggest loser. And China down 2%, Korea down 1 1/3, Thailand. These were all the Asian. It was Asian, not Turkey and Argentina, that weighed down on the emerging market space. And of course, there's France. France here. There's Japan, of course. Germany down 1% today. You can see Australia and Netherlands. This would be Switzerland. A lot of these German all lagging behind the ACWI. The only outperformers on a European basis were Spain. Italy is continuing to outperform, one of the only European countries with the gain. And then there's your S&P 500. Your S&P 500 continues to be the strongest performer among these major global economies. Here's the top 12 global economies, and the S&P is the only one above a rising moving average. Even Korea today dropped below its moving average, and we'll show yellow tomorrow. With everything else, India is showing yellow. A little bit of an engulfing pattern today. It's a positive development on India. Long lower shadow, positive development on Canada. But everything else is below falling moving averages with bearish intermediate postures. Only Korea is still avoiding a bearish intermediate posture by 1.83 points. The market forecast for the S&P is still strongly bullish. It's the only one that remains green outside of Korea among the major economies. So, we're getting weakness, but the weakness isn't coming from bearish investor sentiment here in the U.S. It's coming from being dragged down by all these other major players out there. If these start to bounce off these lows, if they start to bounce off their lows, then that will probably pull up the intermediate. That's what I'm expecting, at least, is they'll pull up the S&P 500 along with it. You can see from an asset class standpoint, with the S&P outperforming today on the international basis, you can see here we go, that these kind of individual, like these different types of equities bouncing up. MLPs bouncing off a low. Preferred stocks not doing very well, but look at dividends bouncing off of their low. Real estate stocks bouncing up. Strong bullish postures. The MLPs, kind of a weak bearish posture there. The dollar continuing to bounce off its lows, putting pressure on these commodities. And you can see crude oil continuing to come down, that long upper shadow yesterday. And then there's your bonds. Bond prices, long-term bonds have been falling. Yields have been rising. We'll see whether or not we get this kind of inverted head and shoulders pattern. You can see even high-yield bonds are falling a little bit more than what the stocks have been. Not today necessarily, but yesterday's move was a big decline. There's your municipal bonds, and you can see some of these other shorter time frames, especially the short-term bonds. But here's your 7 to 10 year, not falling very much at all. It was your longer-term bonds, but still holding up better than growth stocks. And you can see IWM, making a late rally to outperform the S&P by the end of the day. So this wasn't. There's a lot of relationships here. Values outperforming. You can see gold doing well. Dividend stocks outperforming the S&P. Real estate stocks doing well too. There's some risk off type plays there, but with EM lagging behind EFA, but you can see in crude oil lagging behind gold. So there's some risk off developments, but not necessarily broad selling. We're not seeing it in these equities. And even these investment grade bonds and other long-term bonds. We're not seeing the buying in the long-term bonds that would also reflect a risk-off move. Again, just simply rotation and short-term weakness is all that we're getting as of right now, and still at what we expect it to ultimately be heading into the end of this week and early next week. All right, if we take a look at how the sectors are performing, here's our rankings according to the most recent sector selector rankings on our blog at marketscholars.com that Brandon puts out every Friday. Right now, healthcare doing really well. You can see real estate and utility. Look at utilities bouncing up today, up to 9%. So, utilities and staples bouncing up. That's a little bit of a risk-off move, especially without yields necessarily taking or falling dramatically. Here's industrials and materials. This is a trade. These are trade-related sectors that typically do poorly when there's trade concerns. So the fact that they're outperforming the S&P is actually a pretty good sign on the trade front. No matter what the headlines or scuttlebutt is, the fact that they're doing well shows that. You can see the biggest losers are this technology and discretionary area. They had been so bullish, but they're starting to pull back. Those are your previous leadership. Again, you expect energy and materials to start to gain if that dollar starts to pull back. And there's healthcare as well, providing some continued strength. That's been our best performer. Continues to have a 90 along with discretionary 90 on the intermediate posture. On the lower end, there's your materials and there's your energy. And they've got a lot of relative underperformance. They're bearish right now along with financials. They've got some underperformance that to catch up. Their 3-month returns are negative. They're the only ones that are negative. So as that dollar starts to pull back, there's going to be a lot of opportunity here. But there's also going to be opportunity to fade some of the strength that we've had in these technology and discretionary areas. You wouldn't expect them to continue to outperform as dramatically with the falling dollar. You'd look for more strength in industrials, materials, and energy, and commodity prices leading the way higher. So that brings us to our trade idea of the day, CREE, C-R-E-E, in the technology sector. It's been trying to start a new bullish trend going here, but failed to get above that moving average and failed pretty sharply today, dropping back down towards the lows of the past few weeks and trading really close to those lows. You can see short-term sentiment pulling back sharply here. And the intermediate posture, which had been weakly bullish, if we turn down from here, it would be that bear. That's a bearish sign a little bit of a flag pattern developing. A breakdown would be bearish too for this. You look at like the long-term view for CRE, you can see that you've got this kind of 50-day, breaking down below the 50-day moving average. We've had this divergence with lower highs along with higher highs there. Sets us up for a move down to this kind of 42.5 area. That will be a significant level here in just a minute when I show you another chart. If you take a look at the 3 green arrows for CRE, and you can see, we obviously have 1 red arrow falling back below the moving average. But if you look at the 2 line versions of this, you'll see that we're back below a falling 8-day moving average. The 8-day is back below its 17-day moving average. That's why your MACD is below 0, and it's almost back to crossing below its 50-day, and you can see the trading towards the low end of the range. The average price is still relatively high over the last 5 days, but there's opportunity for bearishness to the downside. If I take a look at a couple more charts here, if you look at the Bollinger Bands, you can see that we're kind of clearing some low. There's some volume in this area that we're breaking down below. The next area of volume supports also at that 42.5, 42.25 level, which is the low point of that divergence. So you can see now there's some bearish potential on this stock from a technical perspective. You're also seeing the bearishness show up on the DMI chart with the negative line getting back up above 25, the positives getting back below 20. So a bearish development, rising ADX, increasing trend strength, again, bearish signs all aboard, all around there. So if I take a look at the charts, then you can say, okay, well, if I sell option, I can sell this 48 option, buy the 50 for protection against the any upside move. I'll have to kind of find a good price in here. The pricing were a lot tighter while the market was moving, so keep that in mind. It was more right around this 47 cents. When you look at the pricing when the market opens up tomorrow, they'll tighten up this bid ask. It's not nearly as wide when the markets are open. If you take a look at the trade here, we're at 53 cents before the market opened. Let's bring it to 52 by the time it closed. You can see decent odds of success, and if I put that line on the chart, that's what that blue line is right there. So we'd have to reverse this downward move, get back up above the most recent high point, the most recent near-term high point, which would be basically breaking this, starting a new bullish trend anyway, and we'd want to get out of it and take a $50 some odd loss at that case. You can see the $50 loss would actually be more over in this area, around 50 1/3, and that line, so that would actually put us right here, but that line will slowly move down as time passes because it's on this side of the cross, right? So that line, the purple line, drops to the green line, so this line, the $50 loss, will move over here. Eventually, you can see at expiration the $50 loss is right in this area. So that's the move it will make between now and expiration, is to get from where it's at now over to the left where my cursor is. So it will get close. In other words, we need to break up above that high for us to get to the point where we'll take a loss equal to what we're trying to make on this stock. And if it were to continue to drop pretty sharply and we were able to get a good gain out of that max gain quickly, then we can take it and move on and find something else. Okay, so that wraps us up for tonight. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, like tonight's video by clicking the thumbs up icon, and comment. Follow me on Twitter for more content like this throughout the day, and also join our community on marketscholars.com as well as on Facebook. Thanks for your time tonight. Again, especially those watching us for the first time. We'll see you tomorrow. Have a great evening, and we'll all catch you next time.